Hello and welcome to the channel. Today we're talking about life insurance, specifically something called Index Universal Life, or IUL for short. Before we dive in, let's start with the basics of life insurance. No matter who you are, beginner or experienced, this will make sense by the end. When it comes to life insurance, there are two main types: term life insurance and permanent life insurance. Term life insurance is the simplest kind. It's pure insurance, meaning it only pays a death benefit if you pass away during the term. There's no savings, no cash value. These policies usually last for 10 to 20 years, and after that, they end. Because of that, term insurance is very affordable. Now, permanent life insurance is different. It's designed to last your entire life, usually until age 100 or even 120, and it builds something extra called cash value, which grows over time. That's where the Indexed Universal Life, or IUL, comes in. It's a type of permanent insurance that gives you both protection and a way to grow money inside the policy. But first, let's clear something up. An IUL is not the same as whole life insurance. People mix them up all the time, but they work very differently. So let's break down how the IUL works. When you make a payment called a premium, that money goes to the insurance company. Part of it pays for the cost of the insurance, and the rest goes into your cash value account, kind of like a savings account inside your policy. Now, your cash value can grow in two ways. One part grows at a fixed rate, kind of like earning steady interest. The other part is linked to the stock market, but without the risk of losing money. Let me explain. Your IUL follows something called the market index, like the S&P 500, which tracks big companies such as Apple, Microsoft, and Amazon. If the market goes up, your cash value gets a credit, meaning it grows. But there's a limit called a cap. So if your cap is 10% and the market goes up 15, you only earn 10. Now here's the good part. If the market crashes, you don't lose money. You just get zero for that period. That's called a floor, usually set at 0%. So your money can only go up or stay flat, never down. Sounds great, right? But how does the insurance company actually do that? How can they give you the good without the bad? Here's the secret. They use something called options. Think of an option like a small ticket that gives you the right to buy something later at today's price. For example, imagine you want to buy a house for $300,000, but you're not sure if the market will go up or down. You pay $5,000 for the option to buy it 1 year from now at that same price. If a year later the house is worth $400,000, you can still buy it for $300,000 and boom, you made a $100,000 gain. But if the house drops to $200,000, you can walk away and lose only the $5,000 option fee. That's how options protect you. Insurance companies do the same thing. They use part of your interest to buy options on the stock market. If the market goes up, they use the profit to credit your cash value. If the market goes down, they simply don't exercise the option, meaning you don't lose any money. So your main money is safe, and only the interest is used to chase growth. That's how the IUL captures market gains without market losses. Pretty cool, right? Now, when it comes to your policy, there are two main ways to set it up. Option 1, focus on the death benefit. That's for people who mainly want life protection for their family. Option 2, focus on cash value growth. That's for people who want to use the IUL as a way to grow and access money later, maybe for retirement, college, or big purchases. If that's your goal, your agent will structure the policy so more of your payment goes toward cash value, not the death benefit. That's what people mean when they say properly structured IUL. Once your cash value grows, you can access that money in two ways. First, through withdrawals, where you take money out. But those can be taxed if you take out more than what you put in. The second, and most popular, way is through policy loans. This means the insurance company lends you money and uses your cash value as collateral. You can pay it back whenever you want, or not at all. If you pass away with a loan, the company just subtracts what you owe from your death benefit and pays the rest to your family, tax-free. And here's the best part. While you're borrowing money, your cash value still keeps earning interest because it never actually left the account. That's how the IUL helps people grow money safely, access it tax-free, and still protect their loved ones. So to recap, term insurance covers you for a set time and it's very affordable. Permanent insurance lasts for life and can build cash value. An Index Universal Life policy combines both, giving you growth, protection, and flexibility. And that's why so many people are learning about IULs today. If you found this video helpful, make sure to like, subscribe, and leave a comment below. Until next time, stay smart, stay protected, and I'll see you in the next video.